Hey, what is going on, everybody? Welcome into another YouTube video. My name's Gabe, and in today's YouTube video, we're going to be diving off the deep end into everything from multifamily financing. We get so many people that reach out and just have no idea what it actually takes to get a loan on a multifamily property in today's market, 2025. It is a much different environment than your uncle who got into the real estate business in the 70s or 80s or 90s, and I'll be able to deliver it to you firsthand because we are active investors. And in this video, we actually broke it into three different sections. The first one being going through the order of a deal, meaning what type of asset do you have, what type of debt should you place on the asset, and then looking at the equity that you have to invest in it. It's more of a framework that you should be looking at when choosing the type of loans that you place on these properties. And the second portion of the video is going to be breaking down the buckets of money, which means what type of debt do you use? Do you use a fixed rate loan, a floating rate loan? And then the third portion of the video, we're going to be using live deals that have different types of debt being placed on them, just so you can see how everything actually works. So without further ado, let's go ahead and let's jump in. And before we jump in, as always, if you find any value throughout these videos and you think the content is valuable, all we ask for is for you to drop a like, comment, and most importantly, subscribe so we can continue bringing the best multifamily education that there is to YouTube. All right, so jumping right into it, the first thing I want to start with is the order of a deal. And the reason I want to go through this is because it's kind of like my checklist. Whenever a multifamily deal either hits my inbox or a broker calls me on it, the very first thing that I go through is the deal. And then the information that I get from the deal allows me to kind of move on to the next piece of the checklist, which is the type of debt. And the reason that we're going through this is because the type of debt that you place on it, meaning where does it come from, what interest rate are you borrowing it at, how long is the hold period, what's the prepayment penalty to get out. There are so many variables that's involved in financing a multifamily loan to pay attention to. So I wanted to give you a high-level overview, my checklist as I'm going through every single deal. So let's go ahead, let's dig in. So the very first thing that I look at is the deal. And you can see under deal, the very two things that I'm looking at is the current NOI, or the net operating income. The reason I look at this number, and it's so important to understand, is because the lenders, whenever I go and I submit an application to get a loan, they are going to underwrite the property as well, and they're going to base their loan amount on the NOI of the property. So you see right here, the current NOI points to the loan amount. I'm looking at how much income is at the property because I'm trying to get a certain loan on it based on what the seller wants. Now, if you don't know what NOI means, all it stands for is net operating income. It's all of the profits at the end of the day. So all of the gross income that you're collecting minus all of the expenses that it takes to actually run the property, that is your net operating income. And so after I understand how much NOI there is at the property, the second thing I look at is the current condition. And the reason I say that is because we're in the value add business. We look for properties that we can go in, we can fix some of the inside of the unit, maybe paint the outside, and we can force the appreciation to the property. Now, as it pertains to the financing side of it, what this is really important for is the CapEx budget, or how much money that you're going to need to complete the project. So again, looking at the deal, the only two things I look at is the current income that I'm acquiring, because it's going to dictate how much of a loan I can get. And then I'm looking at the physical condition of the property to determine how much work it's going to need to force the value. Now, really quickly, something that helped me kind of piece this stuff together is you want to look at real estate kind of as like a puzzle. And if you move this one piece, one thing over here is going to feel the effect. And so what do I mean by this is we found out what the current NOI is and the current condition of the property. That allows us to choose the certain type of debt that we want to place on it. Meaning if we go out and we find a property that's been owned for 30 years and the rents are so far below market, you know there's very clear upside for it. There's just not going to be enough income to support the purchase price that they want. So you're going to be forced to use a different type of loan. So we look at the deal, and then the deal dictates the type of debt that I can use on it, whether it's going to be a fixed rate or a floating rate loan, and we'll go through what these mean. And more importantly, looking at it from like the overall acquisition, if you're going to pay a purchase price, how much of a loan can you get? Because that's going to dictate how much you have to bring to the table. So how much leverage can you qualify for the deal? So the deal dictates the debt, and then the debt dictates the equity. This is the last piece in the puzzle that I look at, because this ultimately is how we make decisions. We go out, we find a property and the seller wants 10 million. We can get a loan on it for 7 million and we have to invest 3 million. That's what starts the deal and lets us be able to make a decision on if we want to do it or not. So again, the order of the deal, whenever you're looking at it, you have to look at the current NOI, current condition. That is going to dictate the type of debt that you place on it, and the type of debt that you place on it dictates the amount of equity that you have to bring and the risk that you're taking at the property. All right, so now moving into the second portion of the video, we're going to be talking about the buckets of money, meaning what types of lenders are out there, and generally, based on the deal that you find, what bucket of money are you going to be taking it to get it financed? So starting out high level, what you see here is a separation between 2 to 10 units, because you got to be clear, if you're going to be focused on small deals, it's going to be financed differently, versus if you're looking at anything that's really larger than $1 million loan balance. These are the buckets of money that you'll likely be playing with. So starting out with 2 to 10 units, where most people are starting when getting into multifamily. So in the 2 to 10 unit range, these are generally the deals that you're going to be taking to hard money lenders, private lenders, local banks, if there's enough income. But most of the time for these small properties, they've been owned for a long time and you have to go in, spend a lot of money to get the value. And so you're generally going to be taking it to the hard money lenders. Maybe if there's enough income at the property, you could potentially look at getting an FHA loan or using a VA if you're in the military and getting into properties with very little money down. Again, this is for the 2 to 10 unit range. I'm a really big fan of starting in the 10 to 30 and just getting a little bit into the bigger deals because it does offer much better terms when it comes to financing. And now moving into the 10 to 100 unit range, this is just conventional multifamily lending. Anything over $1 million and up to really $100 million is generally going to fall under one of these 3 buckets. And so the 3 buckets, we have agency debt. This is essentially Fannie Mae and Freddie Mac. This is a government sponsored enterprise, meaning the government funds a certain amount of loans every single year and gives it to borrowers like us. Now, the next bucket we have is CMBS. This is commercial mortgage-backed securities. So this is banks like JP Morgan, Chase, Bank of America, Truist. These are banks, credit unions, and anybody between, like life insurance companies, but mainly this is going to be your bank. It's very similar to an agency where they're going to lend on the same requirements. The biggest difference here is going to be relationship. They have a little bit more flexibility being a bank opposed to a government-ran agency. And depending on who you know, you might be able to get certain things done. And then the last bucket of money, which everybody's familiar with in single family, is hard money. It's just referred to as bridge debt. Over in the big commercial world, these are private lenders and these are debt funds, literally companies that go and raise money and lend them to people like us. They're playing at a much larger scale, but it is the traditional hard money MO where it's very expensive money, short-term loans, and it is meant for the properties that have a lot of distress, need a lot of work, but there is a lot of money to be made, generally higher risk, shorter term, easier to get. So for agency and CMBS for the bank debt, you're most likely going to be getting a fixed rate loan, short to long-term terms. These are 5, 7, and 10-year balloons, so you have a long enough period and you don't have a gun put up next to your head the entire time. Now, the biggest difference between the agency and the CMBS is sometimes, like in today's environment, the agencies have been giving better rates and better terms. It's just a whole lot harder to actually get into it. So the paperwork and the scrutinous process that you have to go through to get a Fannie Mae or a Freddie Mac loan, it's very tough to get a loan if you don't have the experience with them. So you end up having to bring in a partner. So it's harder to get into because it's cookie cutter and you have to check their check boxes. But if you can get it, generally you're going to get the best terms. And again, the bridge debt is floating rate and it's short term. So like for instance, all the people that are in trouble right now from buying in 21 and 22 borrowed money on bridge debt, meaning they have a maturity date today and their values of the property went down and their mortgage payment almost tripled. So this carries the most risk, but it's the easiest to get into. All right, so jumping into the final and the most important piece of this is how in the world does all of this actually come together? I'm going to show you 3 different examples of traditional deals and how you're going to end up financing them based on some of the constraints. So let me just show you what I mean. And if you guys have any interest in grabbing this 5-minute deal analyzer, you can check the links in the description. We actually are offering it right now for just $27. You can underwrite deals really quick. So let's go. So the traditional deal that I like to look at and start with is a 24-unit building that you can buy for $2.5 million, so almost $100,000 per unit. The rents in place are $1,000 and you can take them to $1,200. So you're going to buy it, you'll renovate the units and increase the rent from $1,000 to $1,200. Now, if you go back to the order of the deal, I want to look at the current NOI because that's going to dictate how much of a loan I can qualify for. So here's our gross potential income, our expenses, and then our net operating income in this case would be $172,000. What does that actually mean? Like, how do we know if that's a good deal? If we're trying to pay 2.5, put a $1.7 million loan and it cash flows $172,000. Well, let's jump in and let's check it out. So again, we're paying $2.5 million for the property. We're trying to put a 70% loan on it, meaning a $1.75 million loan. How do we know if we can qualify for this loan? What the lender is going to do is they're going to lend on what's called DSCR, or debt service coverage ratio. All it is a cushion to make sure that the property makes enough NOI to cover the mortgage payments that they're going to lend on. So in this case, this DSCR is 1.24. The industry standard is 1.25. So a lender is going to look at this property, look at the current NOI and say, okay, there's enough NOI to give this $1.75 million loan. Now, just because we can get the property and get the loan, we have to make sure that there's enough upside at it. And because of the conditions of the property, we can go in, we can renovate it and increase the income. I want to look at how much growth there is on the NOI that we bought versus the NOI that we're selling. This is a metric that I look at largely in the deal to see how much profit is there. And so in this instance, there's 36% growth on the NOI by increasing rents simply $200. Now, just to show you the pro forma value of this property is we sell it at a 6% cap rate. The NOI in the future is $235, meaning we're out of the property at almost $4 million. So there's almost $1.5 million of potential profit to take on this deal. And we can get the loan. This thing is a great deal. So I would be taking this to an agency or I would be looking at a bank. So bringing it back over to the financing side, in that scenario where we have enough income in place to qualify for a fixed rate loan, I don't need to take on as much risk because there's enough income. So I don't even want to take bridge into this consideration right now because there's enough income. Now it's a question of which lender am I going to get the best terms from? Is it going to be from a bank? Or is it going to be from the agency? So at this point, I would take the deal and I'd go send it out to a debt broker and I'd get it sized up by an agency just so I can compare the two. Now moving into another example of traditional deals that you see that have been owned for a long time, but way below market rents, and the indicators that it's a great deal itself, but you run into the hurdle of how in the world do you finance it? So that general deal looks like this. Same 24-unit building, doesn't have enough income in place, meaning the rents are at $800 instead of $1,000. So instead of them selling it for 2.5, we get in at 2.3 million, so a little bit less. And the biggest difference here is there's much more upside on the property. So you can take rents from $800 to $1,200, and that is a giant movement. And so going through the same checklist, you can see there's a really big difference here where the DSCR on the property is only 1.08, meaning the current income does not support the loan amount that we're trying to get if we're trying to take it to an agency or a bank. So you guys can see I'm already probably going to go to the bridge option. The question is there enough upside to warrant the risk that we're taking? Because we're going short term and we're going floating. Again, I'm looking at NOI growth. What are we buying? Where can we take it? The NOI is 130 going to 260, and it's an 87% growth on the net income, which is massive in comparison to the last one. So I'm taking a little bit more risk on with the current cash flow of the property, but because there's so much upside on it, it makes sense. Now let's confirm it by looking at the actual returns. Again, we'd sell at a 6 cap, take our future NOI, and we're getting a value of $4.3 million. So in this case, because we got in at a little bit less of a purchase price and we had a lot more upside on it, we actually made more money on this deal, and you want to if you're going to be taking on that type of risk. So again, tying it back together, that deal perfectly fits under the bridge bucket because again, it just doesn't qualify for either of these, or you could do it and just have to invest a lot more money it doesn't make sense, you would take it to a bridge. So hopefully after going through the order of a deal, you now have the framework that you should be looking at it. Again, look at the deal, the current income, and the condition. That will dictate how much of a loan you can get and how much work you have to do. Now, whenever you find a deal, you'll have an idea of what type of debt you'll have to place on it to make sense of it. And then after seeing a couple live examples, you have a lot more confidence in knowing what to do to start taking action when it comes to multifamily. You stayed till the end of the video. I know you've gotten a ton of value. Make sure you help us out by dropping a like, comment, especially what you want to see on the next video. And if you need any help as you're navigating multifamily, check the links inside the description. We have a free community you can be a part of where you can meet thousands of investors. Thank you so much. I will see you in the next video.